Hello everyone, welcome back to my YouTube channel The Psychological Investor, where wealth generation is simplified. In this video, I'll be talking to you about life insurance. It is the second most important step in ensuring your family is financially secured. Before we start our investment journey, it is important for us to build strong pillars so that our investments are well protected. Life insurance and medical insurance are such strong pillars. Let me explain you in details why having a life insurance is important. Again, this is in spite of you having a life insurance coverage provided by your employer. Why do you need a life insurance? Ask yourselves this question: what will happen to your family in case of your sudden death? For sure, emotionally, it's a big family member loss and it's a big trauma for your loved ones. Now, let's talk economically. What if you're one of the earning member of the family and your family is financially dependent on you? Who will pay for the house expenses? Who will pay for the house EMI or a car EMI if there's any? What about child education, etc., etc., etc.? I know it's a very sensitive topic, but please imagine this situation and you will get an answer whether you need a life insurance coverage or not. Now imagine a situation where you have a life insurance coverage and there's a sudden death of yours. For sure, emotionally, again, it's a big family member loss, it's a big trauma for your loved ones. You cannot control this, we cannot mitigate this, but at least economically you don't put your family under financial burden, there's no financial stress, and your family is financially secured. Remember, having a life insurance is to ensure that your family is financially secured. Now that you are convinced having a life insurance coverage is quite important, the next question you might have is how much coverage is sufficient? The thumb rule is the coverage should be equal to either 10 times of your annual take home salary or 20 times of your annual expenses plus full amount of outstanding loan if you have any. When do you need a life insurance coverage, or rather at what stage of your life you need to buy a life insurance coverage? Ideal situation would be as soon as you start to earn. Earlier the better. Similar to medical insurance, the premium increases exponentially with an increase in your age. For example, if you take a life insurance coverage at the age of 30 for a cover of about 3 crores, the premium would be about 10,000 per annum. Now, if you take same coverage at the age of 40, the premium would be double. Moreover, this double premium you have to pay until the end of the term. Unlike medical insurance, the premium increases at a certain age, but here under life insurance, the premium is locked in at the first year itself, and the same premium you have to pay until the end of the term. There will be a small variation in the premium, but not much. Not the variation like how you've seen the variation in the medical insurance. That is why it's very important to take at an early age so that the premium is locked in until the end of the term. Remember, you need to revise your coverage from time to time. Suppose you have considerable increase in your take home salary, then or there's a considerable increase in your annual expenses, then you need to revise your coverage accordingly. Or let's say if you have taken any housing loan or any additional loan, then you need to revise your coverage accordingly. There's a possibility that you don't need a life insurance coverage. You don't need a life insurance coverage when no one is financially dependent on you. For example, at the age of 20, when you wouldn't have even started to earn, there's a high possibility that no one is financially dependent on you. In that case, you don't need to take a life insurance coverage. Come at the age of 30, there's a case that most of the cases that there will be a possibility that someone will be financially dependent on you. For example, parents' well-being, child education, car loan, home loan. In that case, you need to take a life insurance coverage. At the age of 60, in most cases, there will be no one who will be financially dependent on you. Your kids would have grown up and they would have started to earn. And if you would have followed the Psychological Investor channel, your investments would be large enough to take care of your daily expenses and a retirement plan. In that case, you don't need a life insurance coverage. I have seen a lot of people taking life insurance coverage until the age of 75 or 99. In my opinion, it's a wrong strategy. You need to take life insurance coverage only until the age where you feel that there will be no one financially dependent on you. In most of the cases, that is until the age of 60. So please don't waste your money by taking life insurance premium or life insurance coverage until the age of 75 or 99 or until lifetime. Take until up to the age where you feel that no one will be financially dependent on you, your kids would have grown up, and your investments would be large enough to take care of your retirement plan and your daily expenses. Other important points that you need to remember while buying a life insurance coverage are: the first one is unit linked insurance plan. What do you mean by that? It is an insurance plan which combines with the investments in equity and debt. A lot of insurance companies will try to attract you with this plan by showing you pay an annual premium upfront, and then at the end of the term you get some lump sum value. Now, at the outset, it will look very attractive and more sensible, but in reality, economically, if you see, you actually lose a lot of money. So please don't opt for this kind of plans. You have to opt for pure term insurance plan. Let me show you with real example. Here, if you see, I have taken a unit linked life insurance product. It is in reality, if you go check in the market, you have this product where you have a life coverage of about 2 crores. I have assumed that I buy at the age of 30, and then the company says that we will pay you a lump sum at the age of 60 of about 1.12 crores. I have just done simple mathematical calculation where I've assumed, okay, there's not an assumption, but annual premium in reality is 1,68,000 is where the company is asking for. I said, okay, at the age of 30, I pay 1,68,000 and I continue to pay until the age of 60. Now come until the age of 60, I continue to pay annual premium, and then if you see here, at the age of 60, what the company says that they will pay me 1.12 crores as lump sum. Now what we have done is, we have taken this annual premium, and what we have done is we have discounted the cash flow. Basically, I have just taken out the present value of this premium. For sure, worth 1.12 crores at the end of 30 years. That is, today's value of 1.12 crores will not be the same worth at the end of 30 years. That is at the age of 60, right? So that is why it's very important to the present value of whatever money we pay or whatever money we get in the future. So this is nothing but the present value. Okay, so if you see, at the age of 30, I pay annual premium of 1,68,000. Today is 1,68,000 is worth the same today itself at the end of 1 year, so it's 1,68,000. Now, then the age of 31, I pay 1,68,000, it will be worth 1,56,000. Like this, I have gone till the age of 60, and then I have assumed that, okay, there's an income, that is why it is in green, 1.12 crores. Now the present value of 1.12 crores at the end of, or at the age of 60, will be only 11 lakh. And if I do a summation of all this, you see it's actually a negative cash outflow. That means I'm going to lose more money. I'm going to pay more, worth minus 9,48,000. That means the annual premium outflow, the present value annual premium outflow, if you see here, it is minus 20 lakhs, and what I'm getting here is only 11 lakhs. So that is why I'll end up paying more of worth minus 9 lakhs. Okay. Now come to term insurance. Here same life coverage for 2 crores. I assume that I buy this term insurance plan at the age of 30. Obviously there's no lump sum because it's a pure term insurance plan. Now here the annual premium, you see here, it's much lower, and it's in reality also it is much lower. It is minus 24,000. That is 24,000 worth of annual premium I will pay. Now same method, what I've done, I've assumed here is the annual premium 24,000. Now suppose I was supposed to pay 1,68,000, here I pay 24,000. I've assumed the balance I invest in I put the money in the fixed deposit. So 24,000 I pay, 1,44,000 I put it in the fixed deposit. I earn some interest, like this cumulative fixed deposit, I continue to earn interest every year. Obviously I have taken the present value, the same method what I did in ULIP. Now here if you see, the total annual I will pay for 30 years, from the age 30 to age 60, is only 7,44,000. And I also get a fixed deposit balance of 1.22 crores. I earn interest of 85 lakhs. So if I take the present value of fixed deposit, I get at the end of or at the age of 60, I will have 12 lakhs in my bank account plus 12 lakhs. Now you compare to this ULIP plan, you look, it is minus. Though I will get 11 lakh, but if I take all the premium and I calculate, actually I will be paying more. I will lose about 9 lakhs here. Here minus 7,44,000 is the total premium. If I take the present value of every year, it is total 3 lakh, but I will also have a fixed deposit balance of 12 lakhs. So net it is positive. And it will be the case. You take any product of unit linked insurance plan, you will end up losing money. So this is why it is very critical and important for you to just choose pure term insurance plan. Don't fall for the insurance company's promises. And like I said, this is the best product I have taken in the market, where they give you 1 crore. You can check if they give you 1.5 1.6 crores plus. Please do this math and you will see that you will lose money. That is why, again I am repeating, it is very important for you to take pure term insurance plan. The next point is claim settlement percentage. Here, opt for an insurance company where the claim settlement percentage is greater than 95%. There is no point buying a life insurance plan from a company where the settlement percentage of that company is lower than 95%. Next point, reasonable life insurance premium. Offer a life insurance plan where the premium is locked in from year 1 until the end of the term period. Also, what I suggest is try to buy a life insurance plan directly from the company through their website. Don't route it through the agent. Like this, you will save at least 20 to 30% of the premium cost. Next point, what if the premium frequency is annual? Here, first year you don't have an option, you pay upfront. Second year onwards, what you can do is you can start an RD where the maturity amount is equal to the premium cost. Like this, the premium could be cheaper because you opted for an annual premium. Second, the interest earned from the RD can be treated as a discount. Next point, critical illness and rider. Here there is no death, but what if you are diagnosed with cancer, kidney failure or liver function failure? Here if the critical illness feature is added in the insurance policy, then the insurance company will compensate you for the loss of pay. Suppose because of this disease you are not able to go to the work and then there is a loss of pay, and they will also pay for the medical treatment of these diseases. Next, the rider. Here, in case there is a road accident and then there is a possibility of partial disability or permanent disability, or there is a severe injury that you have incurred, then the insurance company will compensate you for the same and also pay the medical treatment cost of it. Next point is, how much does a term insurance cost? Again, it depends on the age, coverage and the term. Normally it varies between 10,000 to 20,000 per annum. I hope I was able to explain you why having a life insurance plan is quite important. It is to protect your family in case of your sudden death. Please remember to take pure term life insurance plan and do not mix your investments with life insurance. Hit the like button if you have enjoyed this video, share it with your family and friends, and subscribe to my channel if you haven't already. See you in my next video. Until then, take care. Bye bye.